Let's get to the economy this morning. Higher inflation readings and tariff uncertainty have the markets on high alert. Over the weekend, two Fed officials said that they would like to see inflation move closer to the target before cutting rates again. Joining us right now is former Fed Vice Chair Lael Brainard. She served most recently as National Economic Council Director under President Biden. Lael, thank you very much for being here this morning. Let's talk about that inflation front and center. How concerned are you about these higher readings that we've gotten?
Well, look, I think the producer price data gave us a little bit of reassurance after the hotter than expected consumer price data. And so the gauge that the Federal Reserve looks at, the PCE gauge, which will come in later this month, will probably come in a little closer to 2.5, core PCE, 2.5, 2.6. Which will be a little bit closer to where the Federal Reserve wants to get. Nonetheless, I see the Federal Reserve on hold. I think they are in wait-and-see mood, given that there's so much policy uncertainty, particularly about tariffs and about immigration.
I mean, I think the Fed's on hold, whether you think about any potential policies down the road anyway. Inflation is hotter than they thought. We've now gotten 3 months in a row where that reading's been hotter than anticipated. It's trending the wrong direction. And even if it comes in at 2.5 or 2.6%, that's not 2%. It's hard to look at this, particularly with the pretty decent jobs market that we have right now, and think that the Fed is going to be in a position to cut rates further, right?
I think that is certainly what the market is anticipating. They really don't see a cut until at the earliest late in the year. As you said, we had been on a disinflationary trend, and the last few prints have come in on the hotter side. We'll have to see what happens in the months ahead.
What do you think about when we look at these CPI and PPI numbers? I mean, it's concerning because that last mile is always the toughest to break when it gets to inflation. And this has just been persistent. It's been sticky. It's been concerning. We did get a survey that we had, CNBC and SurveyMonkey this morning, that showed that almost 2/3 of small business owners are pretty concerned about inflation rising up again at this point. Do you feel better about it than that?
Well, we certainly saw that in the Michigan consumer sentiment numbers as well. I think people are worried. Now, certain prices are going up and have gone up by a lot, like egg prices. And those are things that consumers buy every week. And so it does bring a lot of stress on middle-class families. So, yes, there are prices that are certainly affecting those pocketbooks again. And I do think policy uncertainty does also bring some doubt to Federal Reserve policymakers. If you do see the kind of tariffs that we are hearing about from the White House and the kind of mass deportations that we're hearing about, those would lead to higher prices in areas that matter a lot for consumers.
As a former vice chair at the Fed, the idea of policy changes is always a tricky one. Trying to figure out what might happen and how to anticipate that. Is your best hope at the Fed to just kind of be on hold and wait for the data to come in?
So the reading I see from, for instance, the chair's comments and other members' comments is that they don't want to get out ahead of policy. There's a lot of news every day about potential changes to policy. And so, yeah, I think it adds to that wait and see posture because you shouldn't go and make changes to interest rates based on policies that haven't yet been enacted.
We were having a conversation earlier this morning, and while the markets may worry about what the Fed's going to do, in some cases, it's the markets themselves that have to be the ones that you worry about and that you have contentions with. When you look at treasuries right now, it's not what the Fed is doing that has driven the long end of the market. It's bond vigilantes. It's worries about what kind of spending we're going to continue to see and what kind of deficits we'll see, too.
Well, that's absolutely right. The kinds of tax cut plans that the White House is going forward with just extending the existing tax cuts, including for the richest 1% of Americans. That's $4.4 trillion of tax cuts. So that's a lot more bond issuance. Now, they've got on the reconciliation legislation on the House side, they've got some spending cuts. But how realistic are those spending cuts? You know, you've got about $1.1 trillion in cuts just in order to pay for tax cuts for the top 1% of Americans, offset by spending cuts that come entirely, potentially, on Medicaid, food aid. That's really going to hurt working families, not good for the economy. And, of course, those tax cuts are simply an extension of existing, so they don't add additional impetus to growth.
Those were across-the-board tax cuts that did help the middle class. And do you, when you say 1%, are you talking about corporations, too? Do you think it was... I mean, do you think that's a tax cut for the wealthy when you bring the corporate tax rate?
No.
A lot of what you were saying just sounded to me like it just sounded like Democrat talking points, that's all those tax cuts were. There's no doubt that it was. I mean, when you talk to a Republican about it, it's the greatest thing that's ever happened. Do you say at this point it was a tax cut just for the wealthy 1% that no one else benefited from the tax cuts from 2017? That wasn't a net positive for growth and for the U.S. economy? Is that what you're saying?
No, absolutely not. These are simply the fiscal estimates of how much additional revenue losses going forward will be necessary in order to finance tax cuts. So it's really, if you look at the $4.5 trillion of revenue losses over the next 10 years, of that, over $1 trillion is necessary to extend the tax cuts for individuals in the top 1% of income. So, of course, in order to pay for that, there have been some suggested areas of cuts. One of the biggest areas, $1.1 trillion of cuts, would be on Medicaid and food aid. And, of course, we know those will go to families that are more cash constrained. And so that could be a real drag on the economy. I'm talking about going forward. Where do you get the money to pay for those tax cuts on individuals? And it's the $1.1 trillion that is needed for extending tax cuts just for the richest 1%. So it's really just a question of how do you pay for it? And that's really getting back to the conversation of, are interest rates on the long end going to be coming down if the U.S. needs to do that amount of borrowing going forward?